the ARC UK YouTube network. Today is August 12th, 2022, not 20. And I'm Hard Money Jim, speaking as usual from Jackson Hole. Another beautiful sunny summer day out here today. Now, the title of today's chat is Money Creation, Who Cares? Who cares how it's done? And who cares who does it? And of course, my answer is going to be, we all should care. And I'll tell you why. This presentation is in 3 parts, and I apologize in advance. I got a little carried away, and I'm afraid it's going to take longer than our allotted time to get through all 3 parts. So today we might only get through parts 1 and 2, and we'll probably have to save part 3 for next time, which is okay, because I think they're all worth discussing. Now, in preview, in part 1, I want to point out how widespread is the lack of understanding of money creation today, and why I think that is. And that's important because in the process, I hope to convince you that we don't have to be ignorant of money creation. It's not that tough, not that hard. Now, then in part 2, I want to go into a comparison of money creation, then and now. And by that, I mean a comparison of money creation under a gold standard and then under the modern banking system. And you're going to see that the process is, at least, superficially, very similar then and now, which I think will be a surprise to some of you. And finally, in part 3, which we may not get to today, I want to offer you some guidance on how you can judge for yourself if any particular act of money creation is legitimate or illegitimate. But as I say, we'll probably not get to that part today. All right, so let me share my screen and we will get going. All right, so money creation is not, you could call part 1 ignorance abounds. Sorry. Money creation is really not well understood by most people. And I first understood the extent of the widespread unfamiliarity with it in a conversation I had with my daughter and my son-in-law about 3 years ago. Now, they had just bought their first home, and we were discussing their mortgage. And I casually mentioned to them that, hey, it's amazing. You bought your new home with brand new money that the bank created out of thin air, money that never existed before. Isn't that interesting? And my son-in-law looked at me and laughed, and he said, no, he said, you mean they loaned us other people's money, other people's savings? And my daughter looked at me as if I'd lost my mind. So I carefully explained, how banks, all the things we talk about here, how banks create new money when they lend and so forth. And the only reason my daughter listened, I think, is that she knows I've spent an entire career in finance and years as a banking analyst. And so she thought I had to have some credibility. And to this day, I'm not sure my son-in-law thinks to this day I know what I'm talking about. But so that was when I first realized how bad this problem is, because both my daughter and my son-in-law are intelligent, seasoned, professional people. My daughter's a successful lawyer, and her husband's an executive at a well-known tech company. And it was on this day that I fully realized how widespread is the misunderstanding of our banking and money creation system. Now, ignorance can be deadly. I'd like you to imagine you live in a community with an excellent water system that supplies you with you and all the townspeople with pure water year after year, decade after decade. And suppose further that you and the other citizens have been led to believe that your water system depends on regular rainfall from some unknown area and that this water simply flows pure into your town, but you really don't know its source. And despite this widespread ignorance, no harm comes to the town as long as the system functions properly. But now imagine that this water system becomes unreliable. Sometimes the water is contaminated, or sometimes it's in short supply. You don't know how it works. So what can you do? If you think you're solely dependent on abundant natural rain for your water supply from some distant place, all you can do is pray for more rain. And now further imagine that there are saboteurs from an enemy country that want to conquer your community, and they are systematically contaminating your water or interrupting its supply in order to make your community vulnerable to attack. Without detailed knowledge of how the water got to your town, how would you ever know this? How would you ever understand how to fight this? You would never know, and your ignorance would put you in danger of losing your civilization. By not understanding, let me fast forward here if I can find my mouse. By not understanding money creation, I think we are like hostages chained and punished by some unseen God. Without understanding, money's influence on us is like a deus ex machina that we can do nothing about. But that doesn't have to be. The problems associated with money creation were created by humans, and they can be solved by humans. In contrast to our hostage here, if you do understand how money is created, you'll be in a position to understand, just to give some examples, how money creation can be influenced and manipulated by the government, how inflation can wreck an economy, or how the selective distribution of new money to government cronies can change the entire economic system that your life depends on. Most people shy away from explanations of money and banking. Their eyes glaze over. They lose track of the simple steps to understand it. I mean, it just all seems too complicated. John Maynard Keynes apparently believed that money creation was so complex that its explanation was beyond the intellectual capability of most citizens. Here's an extended quote from his 1924 tract called The Economic Consequences of the Peace. I'm going to read the whole thing. It's partially quoted here on your screen. Quote, Lenin is said to have declared that the best way to destroy the capitalist system was to debauch the currency. By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. By this method, they not only confiscate, but they confiscate arbitrarily. And while the process impoverishes many, it actually enriches some. The sight of this arbitrary rearrangement of riches strikes not only at security, but at confidence in the equity of the existing distribution of wealth. Those to whom the system brings windfalls beyond their deserts and even beyond their expectations or desires become profiteers, who are the object of the hatred of the bourgeoisie, whom the inflationism have impoverished, not less than that of the proletariat. As the inflation proceeds and the real value of the currency fluctuates wildly from month to month, all permanent relations between debtors and creditors, which form the ultimate foundation of capitalism, become so utterly disordered as to be almost meaningless, and the process of wealth getting degenerates into a gamble and a lottery. Lenin was certainly right. There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency. The process engages all the hidden forces of economic law on the side of destruction, and does it in a manner which not one man in a million is able to diagnose. So, Keynes apparently thought that money creation and its consequences is just too complex a subject for most people to understand. And the widespread ignorance about money and banking that's out there today make it appear maybe he was right, because average people really don't know money creation. I've already related the story of my grown children who did not know that, bank lending involves creating new money. just as I suspect many of you did not know about this or care about it before tuning into these discussions over the last few months. But it's not just intelligent lay people who lack this knowledge. Politicians don't know either. In an excellent recent paper called Examining Modern Money Creation by Professor Andrew Hook of Sussex University, that's in the UK, the author states the following, quote, "A study conducted by the University of Zurich in 2014 about the level of knowledge in the general population about the financial system found that only 13% knew that private commercial banks provide the majority of the money in circulation. 73% mistakenly believed money is created by the state or by the Swiss National Bank. This ignorance extends to politicians. In a 2014 survey by a monetary reform group called Positive Money, they found that only 15% of UK members of Parliament realize that private banks create the money supply. I remind you that UK members of Parliament, as well as the Congress of the United States, regulate their central banks, supervise their central banks, and they don't know where money comes from. Okay, how about financial journalists? I read, my wife says I read all day. I mean, every day I encounter a comment or analysis by some journalist who misrepresents the money creation process with some kind of a false explanation of how deposits or bank reserves work. I frequently see comments like, quote, "Banks are lending their deposits," or "Banks are not lending out their reserves." What about PhDs? You know, many, and perhaps most, really do not know how money creation works. Even most free market advocates that I encounter, these are often allies and friends of this audience, subscribe to the incorrect money theory of the late Paul Samuelson. Now, Samuelson claimed that money creation begins with a cash deposit into a bank, and that part of that deposit is then loaned out, and that no single bank can create money, but that a network of banks can magically create money by a series of deposits and loans. Now, this theory is baloney, and its acceptance is the source of other errors that further get in the way of understanding. Now, I'm going to leave a critique of Samuelson's doctrine for a later day, but today it's much more important to give you a positive explanation of how money creation does work, rather than try to back into it by explaining why one famous explanation is wrong. Now, finally, if you're not sick of hearing about economic ignorance, I'm going to highlight my own personal survey of this problem. This is a picture of 3 economics textbooks I have purchased myself. As far as I can tell, most of the undergraduate economics textbooks have gotten money creation wrong. And to test that proposition, I purchased these 3 popular college level textbooks, and I reviewed their treatment of money creation. The most famous one is the Samuelson, up on the lower left there. And this is the original and very famous 1948 edition. The other 2 by Cicchetti and Brandl are specifically on, the whole books are on money and banking, and they were recommended to me by a personal friend of mine who's also a professor of economics at a good school in the Western US. He recommended both the Cicchetti and Brandl books as both widely used and representative of how money creation is taught at the undergraduate level today. And my friend's been teaching for 30 years. I've reviewed these books, and I think they're either outright wrong or contradictory in their treatment of money and banking. So don't despair, though. There's help on the way. At the end of this talk, I'm going to give you a list of scholars and sources that are getting money creation right. So please stay tuned. Now, it'll probably surprise you when I say that despite the widespread misunderstanding about money, which would imply that money creation is very hard to understand, that I believe Keynes was wrong. It is not difficult, in my opinion, to grasp how money creation works, because I think learning the basics of money creation is no more difficult, for example, than learning your multiplication tables or learning to recite Paul Revere's Ride. You remember that? Listen, my children, and you shall hear the midnight ride of Paul Revere. I think that's 12 or 13 stanzas. It's a long poem. I had to memorize it in the 4th grade. I mean, that's within anyone's ability. Here is more likely what I think is the barrier to learning. There is indeed a barrier to learning about money creation, but the barrier is not mainly an intellectual impediment. I think it's mostly a psychological barrier, and John Kenneth Galbraith put his finger on it. The process by which banks create money is so simple that the mind is repelled. When something so important is involved, a deeper mystery seems only decent. Now, Galbraith, like Keynes, was a socialist. So he's no hero of mine in terms of economic thought, but sometimes we can learn a lot from ideological adversaries. And here, I think his specific insight is actually quite valuable. To most people, the idea that money is conjured out of thin air by a commercial bank, that idea is equivalent to saying, babies are delivered in sacks by storks, or Santa Claus slides down the chimney with toys. It's just unbelievable. It's especially difficult for normal, hardworking people to accept it. How do they accept that money from nothing is normal? I mean, reasonably decent people are proud of their work, and they're proud of the fact that they've earned every penny of their money. Their money is part of their life's record. It's like the frozen value of all the hard work that they've performed. It's an important register of their productive life. So how could anything as important as their life's work be trivialized by what appears to be an arbitrary process where money kind of magically emerges like a rabbit from a hat, just by a computer keystroke at a commercial bank? It's just like Galbraith says here, the mind is repelled. Now, but yet we use bank deposits every day. We accept their use. Why do we? I'm going to quote now from a very good book called Where Does Money Come From? Quote, part of the widespread acceptance of bank deposits as payment may be due to the fact that the general public is simply not aware that banks do indeed create the money supply. In other words, if you understood it, you couldn't believe it. It's like learning, that you were adopted after years of being told by your parents that you were, born into the family. The mind is repelled. It's just like the magic water system, we accept money's okay just on faith. Nevertheless, it is a fact that money is created with a computer keystroke made by a government chartered bank. The process and all its important details can easily be mastered by any literate person, whether or not you have any background in finance or investment management. You just have to not allow your mind to be repelled. By understanding a few simple principles, you can become the one in a million described by Keynes, the one who understands how inflation, which is excessive money creation caused by the power of government, can unjustly rearrange wealth, disrupt everyday economic planning, impair economic production, and cause economic progress to stagnate. And equally important, knowledge of money creation can enable you and your family to survive and perhaps even prosper during inflationary times like we face now. In other words, knowledge of money creation can make you a better voter and a better investor. If we understand the money creation process, we can understand all the pressure points along the way of that process that governments use to manipulate money creation and achieve their purpose. And you, by understanding the process, will better understand the buildup of unpayable sovereign debt and what the government's response to it must be. And you will learn to understand that the financial repression that is coming our way, how to defend it for your personal financial survival, and why you should support local candidates who are not political candidates, I say, who are committed to sound money. Okay. So to understand modern money creation, we need to understand the origin of modern banking. How did it come about historically? And as usual, we are going to start with what was money for thousands of years until the mid-20th century, and that is gold. Now, I take for granted that you know something about the history of gold and its universal acceptance of money. So let's examine how money is created under a gold standard, and please let not your mind be repelled. But before I get into that, let's pause here for a few questions or comments before I go into money creation under gold. Daniel, do we have anything?
We have a super chat from Bonnie, so thank you, Bonnie, but no questions.
Okay, thank you, Bonnie. Bonnie's a stalwart. Okay, let's call this part 2, money creation then and now. As you know, gold was the world's money for thousands of years prior to the mid-20th century. A big part of gold's story is the development of modern banking, which, as far as we know, developed mostly in Europe around the 15th century. Now, originally, goldsmiths, and these were tradesmen who refined raw gold and fashioned it into jewelry or tokens or coins, became safekeepers of gold. And why? It is because they were a trusted profession and they had secure storage facilities. They performed a valuable service. Modern money probably started when goldsmiths issued paper receipts as evidence of their depositors' ownership of gold. So these paper receipts could be redeemed for gold at the goldsmith on demand. But these paper receipts were more convenient to carry than physical gold. They were lighter, they're easier to conceal, and the gold itself was not subject to wear and tear or erosion due to constant handling. So these receipts were exchanged among people as money in ordinary commerce. But when he was acting merely as a safekeeper, the goldsmith was not yet a banker. We don't know exactly when it happened, but at some point the goldsmith realized that the gold depositors were practically never redeeming their paper receipts for gold. At some point, it dawned on the goldsmiths that they could print more paper receipts than they had gold on hand, and then lend out these paper receipts with interest. So just like these original receipts, the additional receipts were promises to pay gold on demand when the receipt was presented to the goldsmith. The difference was now that there's more receipts than there was gold behind them. These receipts, all of them, circulated equally as money. Okay? Now, at this point, I want to introduce some terminology conceived by Ludwig von Mises, the great Austrian economist, that will help us understand different forms of money. Mises called these paper receipts for gold, quote, fiduciary media. And now I'm quoting from George Reisman. Fiduciary media are transferable claims to standard money, payable by the issuer on demand, and accepted in commerce as the equivalent of standard money, but for which no standard money actually exists. The larger part of our money supply today consists of fiduciary media in the form of checking deposits. Standard money, in contrast, is money that is not itself a claim to anything further. It possesses ultimate debt-paying power in that when it's received, no further claim to be paid exists. So under a gold standard, gold itself is standard money. Paper claims to gold are fiduciary media. In my analysis here, both are classified as money. The process of creating fiduciary media now is illustrated on this slide. The Goldsmith's asset as a safekeeper is the gold he holds in storage, and his liabilities is what is due on demand to the depositors. The evidence of these liabilities are the paper receipts he issues. And these receipts, remember, circulate as money. Now, note what happens to the goldsmith's assets and liabilities when he lends out additional paper receipts. And by the way, these paper receipts eventually came to be known as bills or banknotes. Now, the first thing to notice is the goldsmith's bank balance sheet gets bigger. On the asset side, he still has the gold on hand. And now he also has loans out to borrowers. These loans are a promise to pay from a credible borrower, and therefore they are a valuable financial asset. The banker has also expanded his liabilities, which is evidenced by the paper receipts or banknotes that he loaned out. He's now on the hook to redeem any and all of these banknotes for physical gold when he's asked. So the whole balance sheet got bigger. This is money creation. Second, notice that the goldsmith turned banker did not lend out his gold or any part of it. He holds the gold in reserve, but he does not lend out his reserves. If he had done this, his gold assets would have gone up, but his gold reserves would have gone down by an equal amount, and the size of his balance sheet would have remained the same. Now, this is still an important principle of banking today. Banks do not lend out their reserves, and it's an important mistake that a lot of people make to think they do. All right. Now, we typically refer to this kind of a transaction as a loan, but it was not really a loan in a literal sense. A loan is the temporary surrender of property to be returned to the original owner at a certain time and place. For example, I might lend you my car and you return it to me as we agree, but while I've lent it out, I don't have use of it. Or I lend you cash, giving up my use of that cash, and you eventually return an equal amount of cash as we agree. But this is decidedly not what the banker did. The banker did not lend any gold. In fact, the banker purchased a financial asset, an IOU, a promissory note from the borrower. He paid for this asset with another promise written on a piece of paper called a banknote. And later on, banknotes, or bank deposits rather than banknotes, became the standard liability instrument. So banknotes and bank deposits conceptually are quite similar. But anyway, this banknote that the banker issues promises that the banker will exchange it for gold to anyone who presents the banknote to the banker. Anyone. The borrower is able to spend this paper money, this paper promise, as if it were real gold. And why? Because of widespread confidence that the banker could always make good on his promise of redemption. So look what happened here. The borrower now has debt to the bank. The bank has a debt to whoever is in possession of the banknote. The bank's debt to the deposit holder, or the promise to pay standard money on demand, now circulates as if it's standard money. This is how debt becomes the basis for new money, all new money. This is called the monetization of debt. Today, in the modern system, systematic monetization of debt is the source of all money creation. whether it's done by commercial banks or central banks. All money today is a product of pure credit creation. That is, debt that has been reorganized to be used as money. Now, banknotes back in these days were popular at first, and they're still in use, but eventually, instead of issuing paper banknotes to lend, banks simply made ledger entries in the borrower's account. Those ledger entries are called deposits, and they're then traded among the people, just like banknotes. Just like the paper receipts before banks started, and just like the paper receipts before the banks started even creating money. So this is how banks created money under a gold standard. And this is still the process banks use to create money. Still the process. Even though the standard money is not gold, but it's pieces of paper like a dollar bill or a 5-pound note that's issued by a central bank. The process has always been This process has always been the way that banks create money, whether the standard money is gold or merely, fiat paper issued by a government. So for a legally authorized bank, creating money is as simple as making a promise to pay. That's all it is. It is, as Galbraith said, so simple that the mind is repelled. Now, today, when banks make loans, they expand their balance sheets just like the Goldsmith did when he became a bank. When modern banks lend money or invest in securities, they expand their balance sheets, acquiring both a new asset in the form of a loan or a bond and a new liability in the form of a promise to pay the seller of the bond in currency on demand. But today, very few people want to use the currency, just like very few people wanted to take out their gold from the bank. They trust the system. Because of this trust, bank deposits are mostly preferred to paper bills because they circulate faster and they circulate easier. Now, there are a few more things about the Goldsmith Bank. This is a free market bank operating with gold as standard money that are important to point out. We've talked about the similarities. Now we're going to get into the differences. First, did the Goldsmith Bank commit fraud by issuing more claims for gold than it could instantly satisfy? Now, if the bank had claimed that all of its outstanding promises were backed by gold, then yes, that would be fraudulent. But as long as the gold depositors understand what is happening to their gold deposits, there's no deception and no fraud involved. So in my view, there is no moral problem in issuing banknotes or bank deposits that exceed the reserves of standard money, as long as all the parties have full opportunity to be aware of it and they're aware of the consequences if things go wrong. Okay, and second, you may ask, is there any limit on how much money the Goldsmith Bank can create by using this ingenious invention that's called monetizing debt? The answer is yes, there are several important limits. At first, the Goldsmith Bank has to make loans that are profitable on average. If the loan cannot be paid back through the profits of the borrower, then it becomes a worthless asset. But the bank's liabilities, the promises to pay out gold on demand, are still circulating and still in force. So the bank's liabilities don't go away just because the loan asset becomes worthless and the borrower can't repay. I mean, these liabilities were transferred to someone other than the borrower when the original borrower spent the money, and they're still circulating out in the economy. The banker's still on the hook. So if the banker has too many loans that go bust, sooner or later, the bank's going to run out of income required to keep its business going, and it can go bankrupt. The prospect of bankruptcy, therefore, is an important limit both on the quantity and the quality of the loans that the bank can acquire or the securities that it can buy. But there's even another, even more important form of market discipline controlling the bank's reserves, and this is a key point. remember, under this gold standard, it's the owners of gold who originally put their gold in the bank for safekeeping or to earn interest on those deposits, or both. Now, if the bank expands its banknotes or its deposits by too much, the gold owners are going to see this as risky and withdraw their gold. And similarly, if the interest on their gold deposits is too low, the depositors are going to take their gold out of the bank and they'll put it in their own vaults. So to keep the reserves levels high, that is in order to retain its ability to redeem gold on demand in exchange for a banknote or deposit, the bank has to make a profit without putting its depositors' gold at great risk. The bank is therefore very strongly incentivized by market forces to make low-risk, profitable loans and then share those profits with its depositors in the form of interest. And this means that the claims to gold in proportion to the actual gold available that's available to satisfy those claims cannot grow too high. The bank cannot risk running a panic or a run on the bank, or it'll be out of business literally overnight, and its owners will likely be prosecuted and or at best tarred and feathered. So there are these natural market-related limits on money creation under a gold standard and under free banking. The most important of these forces is that the gold itself is in limited supply. It's hard to increase the gold supply. It has to be mined, and mining uses scarce resources that compete for other uses. So the point here is the Goldsmith Bank cannot deliberately or systematically create money for unproductive purposes. Its survival depends on sound business practices and the faith of its customers. Okay. Now, let's now compare how we do it on time. This is going to work out about. And Smith Bank with a modern bank. Now we can see that the mechanics of money creation here, this is a modern banking system. Let's call it modern bank. They're basically the same as they were at the Goldsmith Bank. The modern bank buys the promissory note, that is, makes the loan, or it buys the bond, and it pays for that with a promise to pay paper cash on demand. Thus, it expands its balance sheet. Like the Goldsmith Bank, the modern bank is limited by market forces. As long as the bank has to operate in a competitive economy, it must make profitable loans because, like the Goldsmith Bank, the modern bank can go bankrupt. Shareholders and management are always going to act to avoid actions that result, to avoid bankruptcy. So there are market forces incentivizing bankers to make sound loans. Now, recall, though, that under a gold standard, the supply of reserves, which was gold, was limited both by the scarcity of gold, which is costly to mine, and by the willingness of gold owners to entrust their gold to the bank. If the bank's depositors lose faith in the bank for any reason, whether it's lack of profitability or excessive risk-taking, they could pull all their gold out and the bank is kaput. But here's what's different about modern banking. Without gold and gold owners to regulate bank reserves, the most important restraints on money creation are no longer there in this modern bank. Reserves are now paper cash dollars or electronic deposits that are convertible to paper dollars held at the central bank. Reserves are created solely by the central bank in an amount decided by the central bank. Now, theoretically, the central bank can limit money creation at modern bank because through regulation, they can set a regulatory limit on the reserves they issue, and then they can set a minimum reserve requirement ratio where bank deposits are allowed to exceed bank reserves only by so much. They do this by regulation. In practice, however, over history, central banks have not even done this. Instead, what they've done is they've tended to supply increasing reserves to the banking system as needed to keep up with the bank's growth in assets. So as banks make more loans and buy more securities, they create enough reserves to give the banks a comfortable margin. So in the modern bank, in actual practice, the bank balance sheet growth, which is loans and bonds, tends to dictate the quantity of reserves, not vice versa. Now, in addition, the supply of reserves in modern bank is not limited by any natural or market mechanism, because bank reserves are created by central banks in whatever quantity they deem necessary. So merely by purchasing sovereign debt securities, treasury bonds, for example, the central bank creates new reserves. And this, of course, is yet another version of monetizing debt. Now, finally, government regulators have taken virtually all the risk out of bank deposits. Excuse me. And indeed, today, bank deposits are considered virtually riskless. They're backed both by deposit insurance and, more important, by an implicit commitment by central banks to not allow the banks to fail. So unlike the depositors of gold, bank depositors today have very little market control over bank reserves. The depositors can withdraw all their deposits in the form of cash and remove the money from a banking system, or they could change from one bank to another. But that, when that money's taken from the bank, when those reserves are taken from the bank, it's easily replaced by the central bank, which can turn debt into physical cash reserves at the stroke of a pen. And they've done this, of course. So the possibility of bankruptcy, assuming the government regulators will allow to go bankrupt at all, is today the last vestige of market discipline over commercial banks. All other controls on credit creation are instituted by the government, as far as I know. So the banks still do create money we use, but the government controls the banks, and therefore the government controls money creation. So I think we're now in a position to see how government control of money creation can be hidden inside the operations of commercial banks. Because money creation still appears to be very similar to the free market system, or the old gold free market system. And of course, many elements of the mechanical elements of the free market system remain, as I hope these diagrams show. And so money creation by the banks appears legitimate because the mechanism of money creation is the same as it's always been. And money changes hands today, similar to how it has always changed hands. So to the casual observer, what has changed? So for the most part, it might appear that our money distribution system, like the water system in my earlier analogy, is just fine, even though it isn't. Now, in the process of money creation, along the way of this process, there are points where government can intervene to control the quantity and the direction of the new money. And so for this third section, I now want to offer you some tips on how to diagnose money creation as sound or unsound. But before I do, I'd like to pause for questions or comments.
We have no questions.
Okay, well, you must all be mesmerized and overwhelmed. So I am hesitant here. I am not going to continue because I'll just give you a preview. In part 3 coming up here, I'm going to tell you, I want to give you some tips on how to know whether money creation is legitimate or illegitimate. And I want to give you a framework that you can use to diagnose any particular instance of money creation and determine for yourself, is this instance of money creation legitimate or not? Is it productive or unproductive? Is it fair or unfair? Is it inflationary or not? Is the new money sound money or unsound money? And under this framework that I'm going to propose, you're going to simply ask a few questions, these 3 questions that will apply to every instance of money creation. And the first question is, who decided? Who decided to make the loan, buy the bond, create the money? Who made that decision? Second question, who benefits from this decision? Which parties? Buyers, sellers, other people, government? And number 3, which is probably definitely the most important question and could really subsume the first 2, was force or fraud employed in the act of money creation? Was force or fraud employed? Okay, so we will first next time go back to the Goldsmith Bank to test these questions. And then we will proceed to 3 or 4 other examples, some of which are legitimate and some of which are not. It may surprise you to learn next week that yes, money can legitimately, in my opinion, legitimately be created in this modern banking system that we have today. It really can, but often is not. And then I'm going to get into finally some good sources of the correct interpretation of money creation that you can use to further your knowledge and combat the rampant ignorance. But with that, I'm going to, because we're about only a few minutes left, one more chance for questions or comments. And I want to say, in this particular case, I am not going to provide a transcript, but I will write a separate essay on Substack that I'll cue you to, and it'll probably be in several parts. But I want to get this down in a very literate form, so I'm not going to just settle with a transcript of this particular presentation. Okay, that said, any questions or comments? And before I say fare thee well.
We have a super chat from Duan, so thank you, Duan, and that's everything.
Okay. If you're coming back next time, I hope you do. Think about some questions to ask, because this can't be obvious to everyone. If it is, you're a very advanced audience, and I commend you. Okay. Thank you all. I enjoyed it, and we'll see you, I hope, next week. Possible I'll have to take a break, but I'm pretty sure I will be back next week. But next time we'll talk about how to determine if money creation is legitimate or not. Take care. Have a good weekend.